The footprint course, Unit 8, Failed Break of Support and Resistance. This is challenge day 12 of 30. In the following slides, we are going to focus on the trading career timeline. The focus is on the importance of time and building experience through various failures. In my experience, is what I like to call a trading career, or what a trading career looks like on a time chart. And the reason is because I think there's so much expectation. If you look at a lot of the advertising that goes into financial markets and brokerages and all that, they tend to spin out this idea that you can learn to trade and make money within 3 to 6 to 9 months or 12 months even. Okay, what I'm going to say to you guys categorically, I mean, I haven't been around by any means of a stretch of imagination for a long career. Okay, I've been trading prop now, entering my 7th year. Okay, so I'm still a relative young trader. However, having mentored a lot of guys younger than me, I kind of know, or I have a very good idea of what it takes in terms of time and what the progression looks like. So that's what I'm going to share with you tonight. I'm going to share that progression with you so that if you're going through this progression and you're in maybe your 1st year or your 2nd year or your 3rd year, maybe even your 4th year, you can relate to the experience I've been through, and hopefully that can just give you that little bit of guidance that you might be searching for. So very simple. It's a very basic chart. On the left you got your capital, on the right you got your time plus experience. Okay, not just time plus experience. Time in front of a screen means nothing. Okay, it's the experiences, the good, the bad, getting caught in volatility, having a malfunction of your computer, having your broker give you a margin call. All of these experiences ultimately add with time. Okay, the more experience you have, ultimately, the better trader you're going to become in the long run. So initially what we tend to see is a linear type down move. Why? Because by the theory of constant progression, okay, in the beginning, you are going to make constant errors. Why? Because you're learning a new skill set. Okay, so when you're learning a new skill set, you are going to make constant errors. By that very nature, your downtrend in capital should be linear. Okay, only if you don't control certain elements of your trading are you going to have an exponential down move. Okay, that's where you just don't get out of a trade, you get stubborn, you go all in, you over capitalize, over extend your risk or whatever, and you go straight line down. Okay, so by theory you should always have a linear down move in your capital. Why? Because you're learning, you're investing in a career, you're investing in learning a new skill. Okay, you're not going to break even in the beginning. It doesn't work like that. That's a fallacy that's been sold to the market. Okay, you have to put money in the game, you have to put skin in the game and learn and experience in order to ultimately get towards the back end of the curve. Okay, what we then see, okay, so typically this is a pure thumb suck, guys. This is by no means statistically proven or anything. I've just wanted to put a number of years that, for instance, it took me in my career. So this timeline of 1, 2, 3, that's simply the years it took me as a trader. Okay, so in my 1st year, obviously my account was heading towards 0 and then ultimately eventually went negative. Okay, it's around the time that I went negative that it was almost like something psychologically switched in my head. Okay, I then finally learned that trading is a game of, obviously you got fixed costs and you got variable costs, right? And then you got leverage. So I started learning all these principles, and I came to the realization that whether or not I trade a 1 lot or a 5 lot, there is no different in the process. Okay, and it's that realization, it was that aha moment that ultimately allowed me to finally, almost settle, my equity curve and start to break even. So I could cover costs every month. Okay, I could pay my desk fees, my licenses, my commissions, my brokerages. I finally could cover those and start to pay myself a wage. Okay, so within the sort of back end of my 2nd year and my 2nd year, I was finally actually paying myself as a trader. Now, make no mistake, guys, I would have been earning far more at a bank. Okay, I would have been earning far more in the previous job as well. So it's by no means that I was making great money, but I was breaking even. Okay, I could survive, I could pay the rent, I could feed myself. Then what I wanted you to notice how the increments around that 0 start to become a little bit bigger. Why? Because suddenly towards the back end of your second, or end of your career, the second year of your career, you start to obviously take on more risk. So you start to through experience and through confidence, you start to have slightly bigger swings, because you start to again trust your approach, trust the process. Okay, and obviously that does lead to bigger downswings as well. Now, the bigger downswings are a psychological factor. Okay, a lot of people forget this. When you start to take a little bit more risk, the one thing you haven't experienced is the bigger losses. Okay, so by the very nature, psychologically, you're not used to a bigger loss. So guess what? When it happens to you first time, it's probably going to be quite damaging, and you're going to see that spike back down. Okay, it's perfectly normal. But if you're not preparing for it, if the day it comes, suddenly you look upon yourself and your process and you try and change everything again, you're not going to make progress. Okay, so accept the fact every time something new changes in your career, expect that there's going to be different sort of circumstances as a result, like psychological effects. Okay. Then obviously you finally get that breakthrough. That consistency comes, okay? Not the Holy Grail, consistency. You find an approach that you trust. You start to leverage it up, and you start doing the simple things day in and day out. You don't complicate it. But most important, once you reach this sort of what I call the third year, you start to make less mistakes. Okay, and that is the key. It's the less mistakes. It's the getting rid of those errors that cause you the little losses, that cause you the little bit of emotional spikes, that cause you to lose control. It's honing in on those errors through experience that ultimately allows you to finally start to make a positive equity curve. That's what it's about, guys. Every skill, it doesn't matter if you're a professional sprinter, a professional trader, it doesn't matter. Okay, we all have to pay to learn in the beginning. Then we all have to try things and experience things so that we can ultimately get that experience. Once we've got the experience and we start to apply ourselves in a more professional manner and rule out the errors, we then start to see the positive exponential equity curve. Okay, it goes exponential for a very simple reason. There comes a point in your career where you realize that the difference between clicking a 1 lot or a 20 lot in the future space, or buying 100 shares and buying 500 shares in the equity space, is no different. Okay, most liquid markets can take that leverage. Right, the only difference is you changing the digits, and that's why your equity curve can finally go exponential. Now, if you think that you can get past year 1, 2, and 3 by taking a course online, or by listening to me week in, week out, you're horribly mistaken, guys. It doesn't work like that. Okay, experience and time comes from you. I can guide you, I can advise you, I can mentor you, but I cannot do these 3 years for you. I cannot experience the linear down move and the investment you have to make. I cannot experience these big losses you take because you're taking on more risk. I cannot experience all those things for you. That you have to do for yourself. Only if you're willing to go through 1, 2, and 3 and patient enough to get past year 1, 2, and 3 will you finally get to see or experience what it feels like to be on an exponential run. This is then the second of our counter-trend trade strategies. Do note, it is obviously a footprint standalone trade strategy. We don't require any other trading tools to observe and execute it. It's also very much passive in terms of execution. We can wait for exact price before executing. As you can see in the slide, we're going to focus again on a number of principles. Some of the standout principles that we're going to really sort of reinforce again in this strategy session is obviously 1, market context, 2, high and low volume with particular focus on low volume areas or imbalances, and then 3, also we're going to revisit the key concept of color lines and why they're so important. Now let's move in to the next of our strategy sessions onto the blackboard. So this strategy is probably one of my more favorite strategies. Like I said to you in earlier units, I've always been someone that's a little bit more of a contrarian.
But the mistake I always made, and this fits in nicely with the career timeline principle we spoke about in the earlier slide, is that what I always found is that in the early parts of my career, from day one, I used to be that guy that would be subjectively looking at the markets, finding what I thought was resistance, and through time I would end up losing money, and my sort of results as a trader over time of trading failed break of support and resistance was really negligible. The important thing, what I want to try and bring across, is that through time, guys, through looking at this approach and understanding the principles better and viewing more and more of examples, what's ultimately going to happen is you're going to develop a process at this point that is going to lead you in time to developing a far more consistent result-based approach. And that's the key of this entire course, really, is to get you to move away from this idea of adopting what we call subjective ideas and sort of almost enforcing your way of thinking on the market, and I'm going to move you to a more objective approach. And hopefully, I know this is only the third strategy unit we're doing, but hopefully now, as we go through the observe, the identify, the execution, you're beginning to see that the observe is there for a reason. The observe is not my opinion, okay? The observe is not I think markets are going up or down. The observe is that the market has shown me something. I've observed it. I then identify that a strategy is in play and I simply execute. Okay, if you can adopt this process, if we can get to the end of Unit 15 and you kind of have that light bulb moment where you go, aha, okay, I'm actually starting to execute in a more objective manner now, then ultimately, my goal as a mentor has been achieved. Okay, so that's pretty much what that entire career timeline was about. So again, write that down somewhere. It's not too late now. We still got quite a few different strategies to go, but I really, really want you to move away from having a subjective approach, having it should go down because of this or that, and move more to this is there, therefore I can execute in this manner. Okay. So, the failed break of support and resistance. Now, like I said, I was always a bit more of a contrarian. I always believed that most breakouts were fake and failed, and I had to learn the hard way that some of them actually do continue. However, along the way, I learned some objective facts, some analysis, which I'm going to show you on the footprint, a few key identifiers that ultimately you can utilize to observe when actually, yes, a failed break of support and resistance is in play, and we ultimately now have a good risk-reward trade opportunity. Okay, so the first thing to identify is ultimately the variation, and there is only one variation. I'm going to start by just drawing it in essence. Okay, in this example, I'm going to use resistance. Obviously, it could be support as well, and we get a breakout of this resistance. Okay, now later on towards the end of the course, we are going to focus predominantly on breakout trade strategy and how we utilize the footprint. But in essence, what the breakout should look like, and again I will cover this in detail when we get to that section, is ultimately the break. Right? Obviously we're seeing an initiative at the high. Now we know initiative should be accompanied in this example, this context, with definitely an imbalance. Okay, so we're first going to see an imbalance, or i.e. a light delta. Okay, and then we're going to run into some liquidity. Okay, liquidity, another word for liquidity will simply just be some passive absorption or responsive. Okay, and the minute we run into that responsive, we're going to see the colors go a little bit darker. Okay, so that's in essence what a breakout looks like. Now, before we can actually get onto this trade strategy of a failed break of support and resistance, we have to learn to identify what is support and resistance. And again, we went through this principle in great detail. There's too much subjectivity in the marketplace about what exactly is support and resistance. So again, I'm going to give you an objective way of understanding. Is there actually support there, or is there resistance, or is there not? Okay, so the first and most important thing is you're going to have to learn to observe when there is actually key support and resistance. Now, the manner in which you do this, it's very simple. Okay, one, you need to lean on the facts, okay, and the facts are going to come in the break. All right, so you can observe the break. That's how you determine whether or not this is a key support or resistance. Now note, the break should have, okay, it should have a low volume area. Okay, we discussed that as one of the principles. So when we break here, okay, we want to see an imbalance, or we want to see a low volume area. In other words, not a great deal of volume being traded. Okay, we also want to see potentially some stops or imbalances. Okay, so either or. Okay, now what we mean by that is ultimately stops. We've noted we'll see 0, so we want to see maybe a 0, 0 times 10 times 100. Again, it all depends. These numbers obviously all depend on the market you're trading. Maybe times 200, but ideally, we either want to see some stops, or we want to see some form of an imbalance. Okay, now why? The question is, well, and then before we actually move, I'll move on to the why now. And then we also want to see volatility. Okay, so if we've been trading in, say, 5-tick ranges or 8-tick ranges, we want to see this impulse move. We want to see the range really expand there. We want to see, the buyers really step in and get stuck in and get their work done. Then the most important thing is once we do run into this liquidity being provided, we want to see the pullback being shallow. Okay, so shallow pullbacks are very, very important. Why? Because if it's a genuine breakout, a breakout by definition means that all time frame participants, okay, so all time frame participants, okay, are ultimately trading in the same direction. Okay, in other words, as we break, anyone short is stopping out, so they're a buyer. Obviously, we've got the initiative, which is a buyer, and then we obviously have some algorithms and maybe some, sort of daytime speculative traders jumping on and being a buyer. So all time frame participants are buyer. Okay, note those participants will include, as we mentioned, influential participants, speculative participants. Sorry. That should be an L and an E, and the last one is our algo participants. Okay, so that's our general category of participants. Obviously, that can go a lot further in depth, but we're going to keep it simple for the sake of this course. Now, okay, so the important thing is first we need to identify when there is key support and resistance, and we observe that with the break. The break needs to have one, low volume area on the break, stops and initiative, and a shallow pullback. Okay, if we see that, we know we've got a genuine break. Why? Because those three observations identify and tell us that all the time frame participants were in agreement. Okay, it's those three facts that tell us that there was a genuine break. Okay, so that's step number one of the strategy. You have to be able to identify what is key support and resistance. Now, how this trade strategy works is very simple. Okay, we know that when there's a key breakout, we know there's now a delta or a cumulative delta in the market. In other words, there is natural positioning. Okay, in this example, obviously we're breaking higher, so there's positive or long positioning in the market. Now, most important, as you'll see when we talk about breakout trade strategy, you want to remain with this. First and foremost, like I'll show you later, you always want to buy that first pullback, stay long, so long as that low volume area holds. Okay, that's the real key to this. Okay, so once you've observed a key breakout, you then need to identify this potential strategy. And this strategy comes into play, or you identify it, okay, when the low volume area or the imbalance, okay, or the stops are filled. Okay, so the moment you see the low volume area, the balance or the imbalance, sorry, and the stops filled, i.e. this area, the moment that's filled out, this trade strategy is effectively in play. Okay, and that's the key. So we observe the support and resistance through very key metrics. We then identify this play once that low volume area imbalance and stops is filled. Now, why does this strategy work so well? It's simple. Okay, your bigger time frame participants don't stop out the same way in which the smaller time frame participants do. In other words, on the break here, okay, a whole bunch of longs got into the market. Now, those people who got long aren't going to be stopping out until we get back below the break point. Okay, and potentially even further down. So in essence, even though the markets come back to fill out this area, this imbalance area, no one is stopping out. So we still have a positive long position in the market, even though prices are now moving lower. Okay, and that's the key to understanding why a failed support and resistance trade works so well. Now, what we're looking for, it's very simple, and this is the variation. We're simply looking for an unwind of that delta positioning. So once we get back below that resistance line, okay, we're looking for the market to begin the process of testing this resistance line. Okay, now what very often happens, and this is something you're going to find with this trade strategy, is obviously we got the break. It'll probably spend a great deal of time maybe going higher, maybe just filling out. And the reason is very simple, obviously. We've got a whole bunch of long participants in the market now, not a great deal of liquidity being provided on the short side. More importantly, as the market comes down deeper, what you're going to find is that there will still be buying participants. Okay, once you fill out the low volume area, there's still going to be buying participants. So people are still providing liquidity on the buy side, even though prices are coming down. And this is the real key to why the strategy works so well. Now, every one of those buyers has got a threshold point, and that threshold point comes below that resistance line we broke. Okay, so what we're looking for, the trade is only in play once we re-enter the original range. Okay, we don't sell it here. We wait for the market to retest the original breakpoint. We then want to sell. Okay, now in terms of stop, we're obviously looking for a stop. Again, don't be too picky on this. Remember, what you're looking for is an unwind of the delta. So you're looking for all those longs to get out, short the market, and the market to unwind to the downside. Okay, so in terms of stops, market dependent. Again, I would look somewhere in and around the footprint. Look more or less, where's the high absorption? Maybe above that. Is there maybe some sort of a initiative? Look for some logical point to place a stop, but don't keep it too tight. Okay, once we re-enter that original range, there is a high probability we're going to unwind and take out those longs. Okay, now note, in terms of obviously volatility and initiative, once we get back below that line, you're likely to see a lot of responsive trade, a lot of two-way trade. Why? Because there's still some last gasp buyers, and equally there's now a lot of shorts that are realizing what's going on and trying to not just get out of their longs but also get into shorts. Okay, now one of the tips that I really like for this trade strategy, and I'm going to give it to you now, is that always be prepared with key support and resistance. Okay, so the moment you see, as I mentioned earlier, the moment you see and identify key support and resistance through those fact-based observations, make sure you put the dark blue line. Okay, why? Because note, once we get back below it, okay, as in this example, straight away your mind's gonna, it's gonna switch on and go, oh, hang on a sec, we're actually back at that breakout point, bang, the failed support and resistance trade is on. Okay, so you can leave the market. A lot of the time, when we do have these breakout days, they may never come back. Okay, note, obviously, this is a strategy that only occurs on the same day as the break. Okay, why? Well, for good reason. Okay, the positioning would have shifted. In other words, what we're interested in is we're interested in the unwind of the positioning once we get back below that key break point. So most important note, we only execute this trade on the same day as the break. Okay, now like I said, once we then get into that trade, you're going to find once we take out that swing point, so in essence when the market re-enters the range, goes back and tests, the real key pivot, the real key unwind is that first swing low. I will show that to you on the charts so you can get a better understanding. Okay, now one last thing to discuss. This is probably the first strategy in which I would consider leverage. Okay, and I'm going to explain it to you why, or leveraging. So what we're looking for, if that's our resistance, okay, the market comes down. Now note, we're looking for our first entry short in and around here. Okay, stop maybe somewhere up here. And we're looking to add on to the break down here. Why? Well, it's simple. We know that we should see potential volatility and price direction and initiative below that previous low. So what we'll look to do is we'll look to short, say, 2 units here and an additional unit on the break of that previous swing low. Okay, and again, what you're going to notice very rarely will I recommend the concept of leveraging or the concept of sort of pyramiding, but in essence, again, let me rephrase that. Sorry, this is not quite leveraging. This is more pyramiding. Leveraging would be just maybe getting a much bigger position on. So if I was to leverage in this example, I would leverage only at this point on that breakpoint. Why? Because we like to see volatility and a real initiative to the downside once we break that point. In terms of pyramiding, I'd obviously look to be short here and then either leverage or add in terms of IE pyramid for the break lower. Okay, now let's go and have a look at some of the examples, and we can see what this looks like on the footprint charts. Okay, so how I wanted to start this was with the just a candlestick chart. Reason being is because, again, I know a lot of you would have probably seen this a lot on the charts. I know some people on a daily candle, you might call this a head fake or a fakie. But in essence, what we've got here is the gold. It is the gold 30-minute chart. And what we can see is our really key resistance here. Okay, it's not key resistance because of that red line. It's key resistance because of the snap in volume. So we can see the volume. Okay, we can see the volatility. Note the low volume area and the initiative. Okay, we then run into obviously some absorption. We get a shallow pullback. That's our shallow pullback before rotating higher. Okay, so that's in essence our key breakout. Now note this color line shouldn't be red. It should be dark blue. Okay, for me I use dark blue, but obviously you can use whichever color you like. Now this is the 20th of November in the gold market, and what we're going to pay attention to is obviously what happens on that breakdown. Now, one of the things I must mention, which is very typical within the strategy, and that's also why I said it can take some time, is when the market does come back in and fill that low volume area or the stops, what it does tend to do is begin the process of moving sideways. Okay, so that's very, very typical. So again, that's why I do not want you, or do not, again, that's why I urge you not to preempt the strategy. Okay, don't think just because it's done the first part that it's going to sell off. Okay, we are only engaged once we get back below the line. That is the key takeaway. Simply because the market very often will fill out that low volume area before moving lower. Okay, as a rule of thumb, in general, markets that are well balanced will tend to always fill out low volume areas. They'll actually, in fact, turn low volume areas into high volume areas. Okay, that is a general rule of thumb. Now, let's go and have a look at what this looks like on the footprint chart. So, yeah, we can see again the example, and we can see obviously the market comes into that resistance area. Now note, resistance or support is not necessarily always one price, and this is why again I want to move you away from thinking that support and resistance is simply just a line. It's not. Okay, it's an area, and this is what we can see in this example. So we can see obviously the first time we come up here, there's a real aggressive amount of volume and a shift in the delta. Now note, we then get a very nice little, sort of a low volume area on auction imbalance. Once we take out the top of that responsive selling, we then get buyers absorbing higher before we then punch higher and higher. Now note, as the market pulls back, obviously this is kind of the top of our resistance. I'd say this entire area here is our resistance zone. So once we take that out, again, notice I was going to hopefully say if I could move this yellow thing, because you'll see a little bit of imbalance, but in essence we've got a little bit of imbalance as the market comes back to retest that support before catapulting higher. Note the very light colors, obviously. Then again, notice the shallow pullback. Okay, so shallow pullback and a great deal of absorption. This is one of the key identifiers again of the breakout. Okay, the shallow pullback is met by very aggressive buying. Okay, obviously then we get the low volume. So notice the imbalances, the very light volumes and extension. Again, low volume, light colors and extension. Okay, and that's the process of the breakout. So we can see this market having broken from, again, somewhere around the 94s all the way up to the 97.5s. Okay, so that's our process of a breakout that's occurred. Now, the first thing we want to identify is once or the most important point is once this area, this low volume area, and this low volume area begins the process of filling out. And we can see that, we can see how suddenly the market begins the process of filling out these low volume areas. Okay, and this is the key. Note the sideways trade. Note the sideways trade. Okay, so that's effectively what brings this strategy into play. So we've seen the break, we've observed the break of key resistance, we've observed the key facts that identify key resistance or support in another example, and we've now seen the market fill out all the low volume area, and ultimately it brings our trade strategy into play. Okay, so let's look at that now and see what happens once we get back below the key sort of area. So note what I said. As we can see, the market comes down. Okay, this becomes in essence now, well, it's actually a little bit lower down. It's somewhere around this price, yeah. So the market came back below the 93s, okay, 93.1, and now it's come back to test that little resistance area. Okay, so this is our resistance area. We can see the market comes into it to test it first time. Okay, it tested a second time, a third time, and a fourth time. So we can really see now how initially we had the breakout, but now the key resistance is now acting as resistance again. And that's really one of the key observations when taking this trade. Okay, so it gives you a real great deal of opportunity to get short. In terms of stop, very simply above the top point there. And again, in terms of, as we said, in terms of our leveraging process, we'd be looking to leverage somewhere below that key swing point. So that's where we would add on to the strategy. That's kind of where we get the confirmation that the strategy now is in full play. Now note, obviously, what we're looking for in terms of target is we're looking for that. We're looking for the unwind of the delta. Note, up until that point, we can see how cumulatively the delta was positive all day. And we can see also, once we came below that price, notice how the delta was still positive. Okay, so the buyer is not giving up. And this is a real key observation. The buyers won't give up until we take out one of the key swing points. And that potentially comes in, like I said, on that first little dip lower when we re-enter the range. Okay, note obviously this didn't quite break down from the break over there, but it did eventually unwind the delta. The sellers eventually got stuck in and the buyers all unwound. Note obviously the very high volume, that is a good signal of the stops. Also note obviously the imbalance as well as the stop outs. A couple of zeros there, a couple of zeros there before the market begins the process of balancing. Okay, so all we're looking for is, guys, we're looking for the short there, we're looking for the leverage somewhere over there, and we're looking to take profit once we get that very aggressive delta unwind. Okay, that then is our static examples of the trade strategy. Let's go now and look at what a practical example would look like in the failed break of support and resistance. Okay, now what this is going to appear like, as you can see on the chart in the candlestick here, it looks like a little bit of a flag. Okay, now obviously, like I said, in terms of imbalance and balance markets, this is going to play slightly better in the imbalance markets. Why? Well, simply put, in imbalance markets, we obviously have the potential for breakout. Why? Because we're trading at extremes. Okay, so at extremes, by the very nature, prices are about to shift into discovery mode. Therefore, we're more likely to see, obviously, more aggressive breakouts. Okay, so we can see the flag here. Now, obviously, what we want to pay attention to is what occurs once we take out that break. So let's just fast forward this and see what happens. Okay, so we come down to that low straight away. Notice the bad low, guys. 140 traded the low, plus another 80 odd. Not a very good low at all. And let's see what happens once we take out this low. Okay, so we can see the first observation. Note the imbalance. Okay, real good imbalance, real good bit of initiative taking place. This is a real key telltale sign. Okay, that's what you want to see on a breakout. You really want to see imbalance. What you don't want to see, and this is the most important part, I'm just going to pause this here. What you don't want to see is that sort of responsive buying. Why? Remember, by definition, what we said is that a genuine breakout, high volume, delta, as we can see, delta in the direction, high volume. But what we don't want to see is we don't want to see the market ultimately being responsive just below the breakpoint. Okay, that's very unusual. Why? Because we said by definition of breakout, all time frame participants are now short. Okay, so we've seen the initiative. Therefore, all time frame participants should be short. But someone is sitting there reloading, and that's a real early bird telltale sign. And this is what you're going to see now in a failed break in support. This is a much quicker one than I showed you in the examples. Again, like I said, these can be across various different time frames. Obviously, the slower ones, the ones that occur over a couple of hours, they can be a little bit easier, but the fast ones are just as effective. Okay, so what we've seen there, really big absorption. Market comes back to that original support. Now note, we've noticed the key breakout. Okay, we noticed the initiative, we noticed the high volume and the delta. Okay, highest volume of the day, also the highest delta negative of the day. Okay, markets now come back into range. Now, like we said earlier, we're not looking to preempt, we're simply waiting for the retest of ultimately the previous low. Okay, that's what we're going to get here. Ultimately, the market comes down, trades 20 lots at 02s, comes down a second time, trades 96 at 03s, and then simply just catapults in the opposite direction. So again, note what we can see, and this is quite crucial. Okay, you can really see, and this is what I was saying to you, you're always going to get responsive sellers in the opposite direction, and that's what the 188, the 144, the 159 is. That's effectively, as the market's gone back bid, you've still got participants that won't give up on those shorts, but instead want to add to those shorts. Okay, and that's the key. Once we then take that out, that's when you should get the explosion to the upside. Okay, so let's see what happens now. Obviously, note that very aggressive reloading from not just the sellers. Just remember, that is ultimately buyers buying at much higher prices. So again, you know, one thing you must learn also about the footprint is that for every seller being aggressive, there's also potentially a buyer being aggressive. Okay, that's an important concept to understand. Okay, so as we can see, market spends a little bit of consolidation, and ultimately the market eventually takes out where those key sellers were, leaves a little bit of a low volume area again, and again note the reloading. Okay, so the sellers not yet giving up. You'll notice when the sellers give up, because you will see a real aggressive imbalance. And again, notice the telltale sign. Okay, as we've come up here, note how the sellers were reloading aggressively and reloading aggressively. Notice how the buyers now are reloading aggressively. Okay, and that's the real telltale sign of the potential for an aggressive move higher. Okay, so that's basically our example then of the failed support and resistance. Now, what I would say, as a general rule of thumb, when we do have these failed support and resistance lines, they do tend to continue in that direction. Why? Because there's a lot of positions caught out. So until we begin the process of filling out this area, like I said to you, in terms of targets, always look for something logical. So if you can see on the candlestick chart here, there is definitely a great deal of low volume areas within this candle. So anywhere in terms of up to 56, 30, maybe even higher would be a good objective for profit taking. Okay, guys, that's our example then of the trade strategy. It's such a good trade strategy. Why? Because it focuses on, most importantly, identifying objective facts in order to execute a very strong trade strategy.